Morning, welcome to Channel MI, the Millennium Investing channel. It is week number 2, and that means the second portfolio update video. What a week it's been. It's been a fantastic week. Mainly last week, I think we grew the portfolio at least £500-600, probably 3-4%, which was huge in the space of a week. I think things have pulled back a little bit just yesterday and today, especially on the FTSE, but overall, can't complain. It's been a fantastic week and month and 3 months pretty much since I started this portfolio, which now looks like really good timing. For those that haven't seen any of my previous videos, this channel is aimed at young investors who have just started their portfolio to try and provide some guidance on different stock picks and trends, give you a view of my portfolio, see what I'm doing, and hopefully provide some ideas. I'd really like this channel to be as interactive as possible, so please do comment down below. Let me know your thoughts on my portfolio, what you think I could improve or what you think is good. It would be really good to hear everyone's opinions. As a bit of context, I started this portfolio, what is it now, coming up for 3 months. Just have a look on the charts. Maybe 10-11 weeks ago, and in hindsight it was a fantastic time to start. I have had my money saved elsewhere and invested over the last couple of years, but when the market crashed, I thought it was the perfect time to jump in, open my Trading 212 app, get a little bit more hands-on with my investments and see if I could take advantage of the downturn, which ultimately is what's happened over the short term. So fingers crossed I can carry on for as long as possible. For those that have been watching the news, it's been wave after wave of this, and then this, and then this. Everyone wondering what the hell is going on, why the stock market is going up when unemployment figures and companies' earnings are going the complete opposite direction. I don't think there's a particularly logical explanation to explain it. My view is this downturn, this recession is different from previous. I mean, if you think of 2008, the recession was caused by the banking crisis and loads of bad debt on mortgages and loans and people going bankrupt, not being able to repay, which just creates a massive knock-on effect for the economy with consumer confidence plummeting and spending plummeting. I think this is slightly different in the sense that the coronavirus has ground the worldwide economy to a halt. It has shut a door. Hopefully when we start to get it under control or a vaccine comes out, that door can open and things can start up again with no serious sort of lasting legacy of the damage that's been caused. Maybe that is a slightly optimistic view. I just feel that the damage caused by previous recessions is slightly longer lasting and would be a slower road to recovery than this one. So in this video we are going to be doing a bit of a run through the portfolio. We're going to be looking at the biggest movers for the last week or so, the biggest gainers, biggest losers. Going to be focusing on a couple of stocks in particular, which should hopefully give you guys some ideas and let me know your thoughts on the stocks covered. So let's dive into the Trading 212 app, which you can hopefully see on the left hand side of your screen. First, let's have a look at the overall portfolio. So 3 months, which started this about 10 weeks ago, so this is the most relevant one. Total, we're just short of 22%. That has come down from about 22.5% as of yesterday. So the FTSE is down today. US markets obviously haven't opened yet. I'm filming this before 2:30. Hopefully they'll have a good day and we'll get back above that 22% level. If I flick through to the day, see where we were. So yeah, about 22.25%, 22.5%, and we just dropped. And we've had a bit of a recovery the last hour or so. So moving into the portfolio, this is the newest addition. 3i Infrastructure, for those that don't know, is a closed-end investment trust which invests in mid-cap infrastructure projects, mainly across sort of Europe, North America, and other developed markets. Really like this company. It invests in sustainable businesses and sustainable waste and energy production and all that sort of stuff. So one for the future from that perspective. Didn't get it quite as cheap as I would have liked. I just bought it on its most recent pullback. It did get up to 286 and I bought it when it's pulled back, so hopefully it continues to ride its upward trend. Next we move down to a cluster of 4 of my favourite stocks, 4 growth stocks: Alibaba, Alphabet, Amazon and Apple. All stocks which I see myself holding long term, all stocks which I think have got plenty of room to grow. I think Alphabet, Amazon and Apple are now at close to their peak, if not all-time highs. I think Alphabet is this year slightly below its all-time high, but not far off. Amazon is at its all-time high, and same with Apple, which is fantastic, especially when was able to get in sort of in the crash and pick these up at a decent price. Alibaba for me is an interesting one. I still think it's really undervalued. I think it's been battered down by the ongoing trade wars between the US and China for the last couple of years. If we go down, we have a look at, the PE ratio 24 for a growth stock, I just think is really, really cheap. If you think Alibaba is often called sort of Amazon, Asian Amazon, if you look at Amazon, a PE ratio of 109, it's over 4 times as expensive as Alibaba. I think it actually has. It's got lower revenue and lower income and a lower profit margin to Alibaba. Look at that, yeah. Alibaba beats them on all 3 metrics there, and their PE is significantly cheaper. So for me, it's, whilst it's at the top of its, or close to the top of its all-time high, it still looks really cheap. And I will probably be adding to this maybe on the next pullback if I can get it a little bit cheaper. Moving down to my banks, conveniently 3 of them sit together: Bank of America, Bank of Montreal and Barclays. I do own JP Morgan as well, which is a little bit further down. The reason for owning these banks, obviously I've got a UK bank in Barclays, American banks in Bank of and JP Morgan, and then Canadian bank in Bank of Montreal. So hopefully split my risk geographically there, and chosen what I feel is the strongest bank, or 2 of the strongest banks in each market. Bank of America bounced back really well from its lows and starting to get towards its sort of pre-COVID levels. Still got some room to run, which is great. So hopefully I'll get towards sort of 50% up on that with a healthy dividend yield, which would be fantastic. Barclays, same, was over 50% up on that. Yeah, it's dropped a bit today. But again, dividend and some great capital appreciation, taking advantage of COVID. Bank of Montreal is one of my favourites. Dividend yield is huge, nearly 5.5 at the moment. I did buy this when its dividend yield was close to 6.5, so fantastic dividend yield. Regarded as really safe, been paying a dividend for a long time, 50 plus years. Low payout ratio, definitely one for long term. A couple more dividend stocks here. Coca-Cola, obviously very safe dividend play. Did get them not quite as low as I would like, but still pretty good. 3.3% dividend, and not going anywhere for the near future. Comcast, for those who don't own Sky, broadcasting company in America, again bounced back well, up 20% on these, and this will just be a long-term hold. Now Dark Group, one of the ones I wanted to focus on today, for those that don't know, Dark Group is the parent company of Jet2, so one of the airlines. My portfolio in general it doesn't, in my opinion, have an awful lot of riskier stocks in it. I suppose it could be argued Dark Group is one of those, given it's an airline, one of the industries that took a massive beating in the recent downturn. Travel and leisure and tourism were probably the worst affected sector. So I did want to take advantage of that, and in my opinion, Dark Group was pretty much the best UK airline stock out there. Its rock bottom prices was trading at close to £20 a share 2-3 months ago, and it dropped all the way down to into the 400s, which is crazy low. The reason I chose Dark Group was its balance sheet. It's been growing every year for the last 5 years, growing revenues, growing profits, and the balance sheet is fantastic. Cash and short-term investments, 1.27 billion. If you look at its debt, no short-term debt and only £1 billion worth of long-term debt, which for an airline is phenomenal. If you look at all the other airlines, or the vast majority, they're carrying much higher levels of debt, which obviously puts them much more at risk, especially at a time like this. So that's the reason I chose Dark Group. Its balance sheet, its growing profits, really low share price, and I picked it up, and it has gone really well so far. It's bounced back 60%. It was about 75% up. It's dropped 6.6% today, but I do expect that to go somewhere up to definitely over probably 1,500 pence, £15 within the next 3 to 6 months. Whether I hold it long term or whether I take some profit, I don't know. We'll see how everything else is performing in the portfolio. Facebook, another one of the sort of core holdings, has done really well at 43%. Another one at an all-time high, and another one I plan on hold for the long term. Probably the FANG stocks: Facebook, Apple, Amazon, Netflix I don't have, and Alphabet, Google as well. I'm just going to hold for the long term. 2 healthcare stocks next. Illumina, really exciting stock, does DNA sequencing, starting to make some fairly big breakthroughs in that industry, so potential for it to run significantly. The one slightly frustrating thing about this stock is it doesn't do, for trading 22, doesn't do a fractional share on Illumina, so you have to buy whole shares, which at the moment are trading for $358, so probably the best part of 280 quid. Which, if you're not sure, is quite a lot of money to invest. That's why I only have one stock in there at the moment, one share. I am considering adding another one, but we'll see what happens elsewhere in the portfolio over the coming months. In mode, this is probably another slightly higher risk play, similar to Dark Group, but one again I had quite a lot of conviction in and was quite confident in. It's a growth stock. They do minimally invasive sort of cosmetic surgery, so facelifts and that sort of thing, becoming increasingly popular. It was on an upward trend before COVID, took a bit of a battering, starting to recover really well. If you look at the income statement, really good looking income statement, significant revenue growth over the last 3 years, and net income growth, really healthy profit margin, which is one of the things that drew me to this. Balance sheet, again, really healthy balance sheet, really low debt to assets and an increasing cash flow. So fundamentals are really good. Pricing was also really good. Low PE, 21 at the moment. I think I bought it when it was about 16, 17, which was crazy though in my opinion, for a growth stock of this nature. So I'm hoping to double my money on this, which might be a little bit optimistic, but we're up 25% in probably a week or two, and I'm expecting this to get back to where it was pre-COVID, which is just short of $50 a share. Yeah, maybe $50 a share. I'm in for 27. So yeah, that's where I'm hoping it will go, at which point I'll make a decision on whether to exit or not. S&P 500, Johnson & Johnson, only £2.32 in this share. It's one that I'm really keen to buy. I think it's a great company, but at the moment it's just too expensive. So I keep it there just to remind me regularly and to keep a close eye on it, so that when it does drop to a sensible level, I will be buying that. JP Morgan, the bank. McDonald's, another discretionary consumer staple stock. Bounced back really well. A lot of the stores are reopening now, up 17%, which is great, but more in the portfolio for the dividend, really. On to Omega Healthcare and Segro, 2 REITs. Omega is in the healthcare sector. Segro is an industrial but focused REIT. Omega is in there purely for the yield, which was really high, 7.75 at the moment. I think when I bought it, it was close to 10, which is, a crazy yield. Ordinarily, those sort of yields are usually quite unsustainable. Omega does have a high payout ratio, but I thought it was a risk I was willing to take, given the dividend yield and the payout ratio was just high, but not unsustainable in my opinion. And that, coupled with the fact healthcare REITs in general are growing, demand for healthcare and care homes is growing generally, and it was in a growing market. I thought that was one I was comfortable picking up. Segro, really like this one, really good upward trend, getting close to its all-time highs. As I say, REIT which focuses on industrial property. I think they were in the news this week. They've just bought best part of £200 million worth of new industrial property in and around London. So still very active, still growing the portfolio. Sensible PE ratio, decent dividend, although slightly lower than a lot of other REITs, which might put a lot of people off, but this dividend is growing, really low payout ratio, and again in a growing sector. So maybe slightly offsets the higher yield I'm achieving on the healthcare REIT. The other REIT is Tritax, so we'll just skip down a few. Again, one of my favourites, another industrial REIT. These guys focus on the big distribution units, so have a lot of blue chip tenants, so the Amazons and the retail and 3PL guys. Up well on these, and dividend is a lot better. I think I got this dividend when it was over 5%, so really strong. Tencent Music Entertainment, this is an interesting one. This is a joint venture between Tencent Holdings and Spotify. Tencent are one of the biggest tech companies in China and Asia, and Spotify, as we know, are one of the biggest music streaming companies. So look at the longer term charts if this one is of interest, although I do think it IPO'd fairly recently. Up 10% so far, which isn't bad. P ratio is sensible when you consider it a growth stock. Really good upward trend. Really strong balance sheet. So that's why it's in there, although I haven't put too much into this one, only £175 worth. So next one I want to focus on is Tesla. one of the most controversial stocks out there. A lot of people love it, a lot of people are not so keen. I am definitely in the love camp. It hit an all-time high yesterday after posting a growth of over 7% on the day, which is huge. Disappointed I didn't buy this a little bit better in the crash. Picked it up a little late, which was frustrating, but I still think it's got a lot of room to grow. Not just because of the electric cars it produces, which I think yesterday they announced they've now created a million-mile battery car, which is an amazing achievement and shows pretty fast and phenomenal growth in the technology, which I think puts them a long way ahead of a lot of the competition. So the electric car business is going really, really well. What a lot of people don't realise is they're not just a car company, they are an energy company as well. They do solar panels and battery storage. So that side of the business is also growing phenomenally well. So the share price just short of $950, which is a crazy amount. I think in the last year, there you go, 365% it's grown. So if you bought it in the 200s, you are laughing at the moment. I still think it's got a long way to run. I think it'll break the $1,000 mark within the next month or two. Not yet showing profit, but I suspect they will probably early next year. Tesla are probably alongside Amazon and Alphabet and Facebook are probably the key stocks in my portfolio, the ones I want to have most weighting in. Moving down, Unilever, the consumer staple, and then I've got my three vanguards, which is the FTSE, the all-world high dividend yield, and the emerging markets. So a lot of diversification geographically there. Obviously, FTSE is UK. FTSE all-world high dividend yield is the highest dividend payers worldwide. So diversification across the whole world there. And then the emerging markets is, again, some of the less developed countries, Asia and India, Taiwan, those sort of places. So these give me a bit of coverage across the rest of the world, which is good. And then finally, Visa, one of my favourites, bounced back really well. With the vast majority of payments now being done online, these guys are going from strength to strength, so hopefully that'll continue. And that just about rounds off the portfolio. Just take a quick look at the allocations. You'll see 30 investments, albeit there's a couple in there which are really small positions. Johnson & Johnson, which isn't really a position at the moment. So 28, 29 investments, split very equally. Facebook being the highest dark group, but nothing over 7% at the moment, which I'm quite happy with. Probably want Amazon and Tesla to be my top two. So I am going to work on building those two up. But yeah, everything very evenly split. Just one other thing I wanted to show quickly, which is a bit of a tip. I obviously have my watch list here, but I also have my portfolio. So I created a new watch list for everything in my current portfolio, which might sound a little bit stupid when you can just look at the portfolio, but you have to click into every stock and go on the day to find out how they performed on each day. Setting up your own watch list with every stock, you can quickly scroll through and see how each stock has performed on that day, which if you just want a quick update and to see how things are getting on, that is probably the quickest way to do it. So that's a quick tip for you there. Last thing to say is thanks for watching. I hope you enjoyed this video. Do let me know your thoughts on my portfolio and my individual stock picks in the comments below. Please also like and subscribe if you enjoyed the video or if you're just a really kind person. This is a new channel and your support would be greatly appreciated. Otherwise, see you in the next one.